Well, thank you very much for having us here, and hopefully what will be a easier conversation to listen into. The first point we wanted to start with is to say that for a very long period of time, and certainly for the larger part of history, interest rates have been remarkably stable. That changed in the 1950s when they started their long upward trend. And the period that we are interested in starts in around the 1980s, which coincides with quite a few things. It coincides with China's initial opening phase, which started around 1979. And it also started with better control of monetary aggregates, followed by an introduction of inflation targeting by major central banks starting in the 1990s. But over that period, as Charles would have said if he was here, the disinflationary forces were so strong and so persistent that really central bankers did not need to work very hard in order to bring inflation under control. And over that period of time, interest rates fell remarkably steadily with very few interruptions, and central banks managed their inflation targeting regimes with ever greater success. Now, a lot of that success has been attributed, primarily by central banks to themselves. However, we think that the telling part of this story is that even when central banks turn the taps on for monetary aggregates to rise and for money supply to get pushed into the economy in the aftermath of the great financial crisis, they were still not able to get inflation back to the levels that they wanted, to the effect that central banks fail to meet their inflation targets almost universally in the advanced economies. Something else must have been going on in the background, and we believe that something else has been a demographic story that pervades not only to inflation, but to wages and to inequality. If we could have the next slide, please. If you look on the left-hand side, you will see two clear lines and a third one that I will talk about presently. The blue line on the left-hand side is the working age population of the advanced economies, and that was effectively the workforce that was available to producers in the Western world and for global production for a very long period of time, despite the increase in the working age population of Eastern Europe and particularly China. Now, the rise of China, we give a lot of prominence to in our book. In fact, it occupies the second chapter. And so we factor it in explicitly. What you can see from this chart is as the integration of China from the 1990s started with the final WTO accession and the most favored nation status provided by the US Congress in 2000, the global availability of labor suddenly jumped over a short period of time from the blue line to a sum of the blue and the yellow lines, which was 120% one-time increase in the global labor supply. We think this is a historical shock that will never be repeated, particularly because China was so effectively able to turn that labor output into goods and services that were then shipped back. Now, there is another part of this story which belongs to India and Africa, which creates a numerical benefit to global demography. But as we will argue, they do not really contribute to an economic understanding of demography. And the reason for that is that the aging of the global economy is taking place in precisely the same countries that are contributing the bulk of global growth at the moment. India and Africa play a role, but that is something that will benefit themselves. If you look on the right-hand side chart, what you see is just around now, the global working age population is slowing down rather rapidly. So ex-Africa, which is the black dashed line, which is a reasonable representation of the workforce that is available for global production, is going to see an extremely severe downturn, part of which has already begun and some of which has yet to be seen. If you can go to the next slide, please. Now, the change in dependency ratios is important to note over here. The dependency ratio, as economists studying demography describe it, is the total number of the young and the old divided by the number of workers. And the simple intuition over here is that how many dependents or how many parts of the population, people in the population who are not contributing to production, does one worker have to lift? And what you see is in the early years, the young contributed to a larger share of the dependency ratio. And as they joined the workforce, the dependency ratio in the advanced economies fell. What is changing now is that the elderly are playing a much larger role. So the rise in the dependency ratio in the 60s and the 70s took place because of the young, and now will take place because of the old. The next slide, please. You're seeing precisely this picture playing out in these two charts. On the left-hand side, what you see is the advanced economies, after seeing a steady fall into 1980, a flat profile since then, since about 2010, led by Japan, and now increasingly be joined by other countries, are going to see an increase in the dependency ratio that is quite severe. And in fact, if you look at the yellow, blue, and green lines, they are being held lower only because of the benign demography that India and Africa have. If you take away India and Africa and some parts of South America, the entire manufacturing floor, and in fact the bulk of the global economy, is going to start seeing its dependency ratio rise rather aggressively. If you can move on to the next slide. Now, where this changes dramatically also is in the case of China. As we said, we have paid a lot of attention to China, and we believe China's role in changing the global demographic and output production profile has been significant. Its integration into the global economy started with WTO accession. Internally, it was able to depend on two very important dynamics. The first of which was an internal migration from the rural areas to the cities in numbers that we have not yet seen anywhere else. Within cities, if you look at the system of hukou passports, the hukou passports allowed the migrants to remain at a very low wage without having access to the same services that the original dwellers of cities had. And that allowed corporations and producers to have access to rural workers in the cities, but still at a pretty much rural wage. The second story that played out was financial repression. Because China had the ability to break the impossible trinity by blocking capital flows at the gate, it was able to keep interest rates low, transfer the savings from households into the banking sector, and then from the banking sector on further on to state-owned enterprises. All of that is changing now. Today, we believe China is past the Lewis point, which means that further migration into the cities is not clearly overwhelming the benefits of that inflow. Second, the inflow of companies and hence technology is getting a lot harder, and the coronavirus pandemic has accelerated some of those stories. And finally, that means the economic and the external environment for China has been transformed, with the result that we think China is no longer a global disinflationary force that it has been for the last 30 or 35 years. Its falling savings, partly due to aging, are pushing the current account further into deficit. And as that happens, it will also affect the commodity producing economies whose current accounts had been pushed into surplus as well. And finally, and importantly, something that we're already seeing again accelerated by the coronavirus, the technological change that China had to see is now having to be produced at home. Next slide, please. The result of all of this has been not only a huge change, a huge shock to global wage growth, but also the social pressures that we have seen in the advanced economies. What we have on this slide is a representation of the points that Milanovic has made, which is that inequality narrowed across countries, even though inequality was a massive theme within countries. What this table is showing you is from 2000 to about 2018, the wages of the Chinese worker increased an astonishing 7-fold relative to the wages of an American worker. And because there are so many more Chinese workers than American workers, what you saw was that overall global inequality was narrowing. The right-hand side column shows the same story playing out in France and Poland, but the rate at which the Polish worker benefited relative to the French worker happened at a much slower pace. So Uh, the next slide, please. So what you saw despite this inequality is that the global shock to labor occurred because of emerging markets at a level of technological expertise of the worker which was relatively low. And that shock led to a much weaker say for the worker in the global economy, especially in the advanced economies, where trade union density fell. And along with that, a point which is not very often made, not only did output growth improve and inflation remain very low, but also the natural rate of unemployment fell, primarily because producers were able to implicitly hold a threat to workers that whatever they were producing would easily be offshored to China and other places of low cost if wages in the local economy went up. And you can see this again in the next chart, where the global shock to labor supply happened at a level that most threatened the incomes of those endowed with low education or those who had sought only low levels of education. This is from author from his American Economic Review article, which shows you that both across men and women, those with graduate degrees or something close to it were able to protect their incomes and even raise it along the same time that China and emerging markets made a huge foray into the global economy and their labor supply integrated with that of the advanced economies. But those with lower skills and lower levels of education were not able to protect themselves at all. And so the result was, even though you had diminishing inequality across countries, inequality within the advanced economies rose quite significantly. Next slide, please. The work over here is from Stansbury and Summers, and it shows you that the Gini coefficient as a result, except in the notable case of Turkey, showed rising inequality over the last 30 years in the advanced economies. And this has led to all the attendant problems of populism, many of which we are still living through and will continue to fight over the next few years. It is very difficult to see when an end to that is in sight. In other words, the shock of the last 30 or 35 years has left a lasting impression on every aspect of our social lives. Next slide, please. What is changing now is the basic story of demography. The reversal, if you remember one of the slides that we had seen earlier on, where the dashed line of the working age population was dropping rapidly. To add to those problems, we now have not only a worsening of the economic dependency ratio, but also the medical dependency ratio. What this table tries to show you is two things. Number one, the proportion of the oldest old, those with ages of 85 years and higher in our populations, is steadily increasing and expected to rise at a very steady pace over the next few decades. But along with that comes an increase in medical dependency. So if you are somewhere between 65 and 75, only 30% of that age cohort needs help with the activities of daily living. That number rises to nearly 80% once you get above 85. And those who come close to the ripe old age of 100, the assistance needed for the activities of daily living are almost 100%. Now, what is the point to be made over here? The point to be made over here is that the numbers that you saw earlier were just the demography and working age population numbers that the UN population statistics show. What they do not show is that a huge chunk of that working age population is going to be increasingly diverted towards looking after the elderly. And that is what Charles and I call socially responsible activities, but not really economically productive ones, because the services that are produced by these carers will be consumed at one time by the elderly, and the elder will not be using any of that to produce capital in the future, which means the scenario for the working age population and the benefits for society are actually far more dire over a period of time than the simple UN population statistics show. What they also bring along, if you move to the next slide, is a huge explosion in debt. Now, this is a chart from the Office for Budgetary Responsibility that was produced before the coronavirus pandemic. And what it is trying to show you is that aging related costs, which are the prime driver of these fiscal issues, will lead to much larger deficits and a much higher level of debt if we even abstract from the massive increases that we have seen in 2020 with the coronavirus pandemic. The same picture, if we move to the next slide, has also come from the Congressional Budget Office in the United States. Most of the increase in the federal debt that is projected that you see as a sharp exponential spike upwards is due to aging related costs. It's just not something that is front and center at the moment because it hasn't hit us yet, but that pressure is certainly coming upon us. Next slide, please. So where does that leave all of us? Well, it does leave us with pushback. People who wonder about our thesis, why all of this will lead to inflation, possibly an increase in real rates and low growth and a reduction in inequality, point to 3 or 4, maybe 5 things that could work against us. First, as I mentioned briefly, is the presence of Africa and India. They have a numerical advantage. Their working age populations are still going to remain extremely young and keep growing, in fact, for a very long period of time. However, the problems are threefold over here. Number one is it's almost impossible to think in this climate that we can import labor from Africa and India and ship it back into the advanced economies. That is something that we think is simply not feasible given the politics of the situation. Second, the role that they have to play is absolutely gigantic because, as I had said before, the aging profile of the world is dominated by the economies, the very economies that are producing the most right now. And the third problem is, well, why not send capital to those economies, have them converted into output, and then ship it back in much the same way China has? Well, the difference there is that China had a single-mindedness, the presence of guilds, in a way that I think the India and the Africa side of the story simply cannot manage. Now, Africa has a size of population the same as India, but has 50 countries, which means 50 different national priorities, 50 different coordination problems. And India has a very, very, very strong tussle between its federal and state governments that is brewing even as we speak. Second, well, why not benefit the limits to the old? Some of that is already happening. In fact, what that has done across the advanced economies is forced the pre-retirement cohort, those between 55 to 64, to raise their participation ratios dramatically. Germany, for example, has increased its participation ratio of the 55 to 64-year-olds from around 45% in 2003 to nearly 65% as of the last count 2 years ago. So some of those things are already percolating through. What about more participation of the elderly? Well, as I mentioned, some of this is happening since the last 20 years, but how much more we can force out of it remains to be seen. And so that leaves us with 2 main objections. First, technology. And here we have 2 thoughts. First is on the view that robots themselves could directly look after the elderly. We think this is probably the most unlikely phenomenon, as you can see. Both Charles and I have family experience with those suffering with dementia, and we can tell you firsthand that what people suffering with dementia need is emotional support. And to put Charles's phrase very eloquently, robots have an emotional content of exactly 0. We think the ability to look after the elderly is extremely limited, and that's not something we depend upon. But we do hope, and indeed we think that there should be lots of disruption in the rest of the economy. We depend on robots and artificial intelligence, reducing the need for workers in repetitive jobs, because many of those workers will have to be reallocated to looking after the elderly. If we do not get the disruption in technology, the demographic problem in the advanced economies will be a lot worse, inflation is a lot higher. And so let me move on to a couple of slides from now. So just this one, there's the last criticism that we generally get. Well, our broad thesis, and I'll talk more about that in a second as I wrap up, our broad thesis is that all of this is likely to lead to inflation. It is likely to lead to possible even real interest rates rising, though that is contentious, and I'll mention that. But why didn't any of this happen in Japan? Why did Japan see disinflation? Why did it see a very stagnant domestic economy? Why did any of this happen in an economy where demography has turned a decade ago? Well, there are three simple points to make here, but the first broad point is the time at which Japan's labor force started shrinking was exactly the time at which China was introduced to the global economy. Japan is not an economy operating under autarky. It is impossible to think that China could lead to disinflation in the entire world, and Japan would be able to stop those disinflationary forces at its doorstep. Or put another way, why do we think that Japan could inflate at a time that China was deflating the rest of the world? But if you look within Japan, there are three things to keep in mind. Number one, we do think what is going to happen is that productivity is going to rise. And we do see that in Japan. As the number of workers and the cost of those workers becomes adverse to businesses, businesses will try to introduce capital in order to raise their productivity and reduce the human footprint as much as they can. This is happening in the services sector in Japan for the last 2 years in a very aggressive fashion, something that the Bank of Japan has written pretty extensively upon itself. But if you look at Japan, it grew at 1%, while its labor force was contracting by 1%, and that means productivity was rising by 2%. If that was offered to the advanced economies, they would snap your hand off. Number two, Japan produced increasingly abroad, and you can see that in the lower left-hand side chart, where the footprint of the Japanese production scene abroad increased steadily over the last 20 or 30 years. And finally, Japan adjusted its labor force through hours rather than employment. Because of their employment norms, what we saw was many people will move from manufacturing to services. Many people will move from full-time to part-time, and those with full-time employment saw a decrease in working hours so that the corporate sector could absorb some of that disinflationary shock that came their way. And the final slide I wanted to move to is the conclusions. Kobe, if you could move to that, please. I'll skip these two in the interest of time. Another one, please. And one more. So where does all of this leave us? Where all of this leaves us is with an inflation story. Now, when we wrote the book, it was in 2019, and we were actually quite uncertain ourselves when this entire story would materialize. The argument that we have had is that the increase in debt will have to be dealt with somehow. With demographics slowing global growth, that is not a way to grow out of debt. We do see some increase in productivity, but not a miraculous one which will help us erode the burden of debt. What that means then is that central banks and the administrations will increasingly have to turn to inflation in order to inflate away some of the responsibility of the burden of debt that they have. What is important to note here is that we are using a real argument for inflation, which is a monetary phenomenon. And the simplest way to think about it is that the young and the old consume, but they don't produce. So they are inflationary. The workers who are employed are paid a wage which is less than their marginal product. Otherwise, they would not be employed in the first place. That means workers are producing a disinflationary or outright deflationary impact. As the dependency ratio fell, the disinflationary impact dominated. And as the dependency ratios start rising again because of the elderly, it is the inflationary impulse that will begin to dominate. Second, we think the interest rate yield curve will steepen. Central banks will have no chance of raising interest rates in the near future, and their policy rates could actually move real rates lower. But that will only mean that the long end of the curve rises faster, primarily due to break-even inflation and nominal yields. Even if there is yield curve control, we think this will be a pro-cyclical move. The result will be that asset returns will be harder to extract, and the combination of all of this will lead to lower within-country inequality, something that will reverse the trend of the last 30 or 35 years once we see the coronavirus pandemic playing out. And as a final point, how does the coronavirus story help? Well, it has accelerated all of our thesis very, very, very rapidly. The monetary aggregates that we are seeing increasing by 20 and 30% have no doubt injected money not into the hands of banks this time, but into households and the corporate sector, who are likely to maximize consumption and production decisions and spend that money at a time when supply will be more and more constrained, which means inflation is likely to materialize about a year after a successful vaccine has been found. But with that, I'll turn it back over to you. Thank you very much for the time.